Most people buy stocks like lottery tickets, which ends up giving them the same disappointing results. In the stock market, the grass doesn't stay green forever. It stays green where you keep watering it, and that place needs to change frequently for good returns on your investment. The professionals don't make this mistake. They treat every stock like a commitment and every trade like a calculated bet. In this video, you'll learn how the professionals pick the right stocks with just a few steps, using a simple checklist. Step 1. Start with the business, not the price. First rule. Pros look at the business, not just the stock chart. Ask one simple question. What does this company actually do? And is that product or service really needed? You don't need complicated jargon for this. If the company sells something people clearly use, like payments, staples, basic utilities, good quality services, it's easier to trust the business. If you can't explain in one sentence how the company makes money, that's a warning sign. Good traders often skip what they don't understand, no matter how attractive the price looks. Step 2. Check the basic numbers like sales, profit, and debt. Think of these as the company's health report. 1. Growth. Is the company's revenue growing steadily over the last few years, or is it flat and random? Slow and steady growth is usually safer than one big lucky year. 2. Consistency. Are profits positive and reasonably stable? Good traders like businesses that make money year after year, not just in one boom period. 3. Debt levels. Does the company have a lot of debt compared to its size? Too much debt means in a bad phase, the company struggles to survive. Pros prefer companies that can handle tough times without begging for more loans. Even a quick look at revenue, profit, and total debt over a few years can show if the company is broadly healthy or not. Step 3. Quality of the business. Next, good traders ask, how efficiently does this business use money? The technical names are things like return on equity or return on capital. But here's the simple idea. If the company uses $100 and consistently generates $15 to $20 of profit from it, that's a more efficient business than one that uses $100 and makes only $5. High and stable returns over several years usually mean the company has something special, maybe better products, a brand, or cost control. Pros love these kinds of businesses because over time they can grow wealth without constantly borrowing or issuing more shares. Step 4. Price matters, not overpaying. Even the best business can be a bad investment if you pay too high a price. One common shortcut pros use is, how expensive is this stock compared to its earnings? You might hear things like P/E ratio, but think of it like this. If one company costs $100 per share and earns $10 per share per year, and another earns only $2 per share but also costs $100, then the second one is clearly much more expensive. Good traders compare valuation with the company's own history, other companies in the same sector, its future growth potential. They don't just buy because it looks cheap or because everyone is shouting that it will go up. They ask, is the price reasonable for what this business delivers? Step 5. Trend and liquidity. Can you enter and exit easily? Pros don't just ask, is this a good company? They also ask, is this a good trade right now? 2 practical checks. Trend. Is the stock in a clear uptrend, downtrend, or just moving sideways? Buying a solid company that is in a long, clear downtrend can trap your money for months. Many pros prefer to buy quality businesses when the price is already showing signs of strength, not while it's falling every week. Liquidity. Can you buy and sell easily without affecting the price too much? Good traders avoid very illiquid stocks, where one big order can move the price sharply. They want to be able to exit quickly if the trade goes wrong. Step 6. Risk first. How much can I lose? The biggest difference between amateurs and pros is this. Amateurs focus only on how much can I make. Pros first ask, how much can I lose? Before entering a trade, good traders usually decide at what price they will accept that they were wrong and exit, how much of their total capital they are willing to risk on this single stock. That might mean using a stop-loss level and keeping position sizes small enough that one bad trade doesn't damage the whole account. They know no stock is guaranteed. A good setup with controlled risk is better than a sure-shot tip with unlimited downside. Step 7. Subscribe to Dollar Dude for more sensible advice. Good traders don't have magical secrets. They just follow a sensible, repeatable process and protect their downside. If this helped you see stock picking more clearly, let me know in the comments which step you were missing till now. Subscribe for more straight talk videos on trading and investing. No hype, just simple, useful explanations you can actually apply.